Let's talk to Goldman Sachs' head of investment credit, Jonny Fine. Nice to have you back here at Post 9.
Great to be here. Thanks for having me.
We get 25. What else do you think we get in terms of a sense as to where things stand for the year ahead?
I think we'll get a reaffirmation that there'll be a cut again in December. I think you'll hear that in the press conference. I don't think there's anything that we've learned about the real economy or the labor market that changes the summary of economic projections that we got at the last Fed meeting. So I think in line for another cut in December, at which point I think the Fed will want to take stock and see how things look early in the new year. And my perspective is that I actually think things are going to look very, very good. I'm pretty bullish as to what the growth outlook is for 2026. So it wouldn't surprise me at all if the Fed's on hold for a more protracted period of time, as opposed to the two cuts that are priced in by next summer.
Is it possible that we have a decent growth outlook, but not a particularly good employment outlook? You know, we've sat here the last few days talking about significant layoffs at companies, just at the beginning of sort of trying to understand what AI is impacting in terms of job growth. How does that set up for next year?
So that's the big question. Are we going to see a divergence or an ongoing divergence between growth and the labor market? And I think the reality is that what we're seeing right now in the labor market is companies pre-positioning for future efficiencies and productivity gains that will come on the back of AI, as opposed to making layoffs as a function of AI-related technologies that can be adopted today. At the same time, as I think growth will take off in a more pronounced way as we get into 2026, I have to believe that that's going to drag the labor market with it. Maybe not quite to the same degree as we would have seen in prior years, as I think that CEO corporate mindset with regards to hiring will still be intact, but I think it will improve the quality of the labor market nonetheless.
You want to take a crack at cockroaches and contagion? What's been your thinking behind some of those comments recently?
So, look, with respect to where we are in the credit market, we've been in the golden era of credit for a couple of years now. When you get to this level of where we are in spreads, there are undeniably going to be some issues that we find under the surface. And you've seen, obviously, a couple of high-profile, high-yield defaults. You're starting to see some strains in the lower end of the U.S. consumer, particularly around subprime. So unsurprising that we're going to start to see a little bit of a noise at the lower quality end of the spectrum. But the fact that that would create broad contagion to the banking sector or other parts of the market, to me, I think those are somewhat far-fetched. At the same time, it clearly warrants watching. And if I'm looking at where we are in the spread market today, it makes me feel like we're priced for kind of really good things, writ large. And I would say there probably is a little bit of risk to the downside, but I don't think that we're near the point of having broad-based contagion.
And what are some of the key parts of your expectations for further growth and increased growth next year? Is it largely rate-related or other things?
I think it's really going to be driven by the ongoing flywheel around the AI system and the CapEx and attendant growth that will create around infrastructure, around construction, and around all of the other associated industries. I think that will continue to be a huge driver of economic growth in the U.S.
As somebody who plays in one of the biggest markets extant, I'm just curious, do you ever sit there and wonder where is all this money coming from? Because the trillions that are now being committed to the growth that you were just talking about of AI, from private credit, from balance sheets of certain companies, on, from investors in the private markets, it is sometimes astounding. I mean, where does it all come from?
Yeah, it's coming from all of those pockets that you mentioned. All of those pockets have been growing as well. In fact, one of the areas that hadn't seen quite as much growth has been supply in my home market, in the investment-grade corporate bond market, although that started to shift. And that's also, I think, playing into the thesis that we'll start to see these very, very favorable technicals that have existed in both the investment-grade and in the high-yield market are going to be challenged by growth, CapEx, and M&A-related financing that I think will hit both markets. Because, as you say, these markets are all going to have to contribute and are all going to have to finance this significant expansion.